Good morning, tech enthusiasts and savvy investors. Buckle up, because today we're diving headfirst into a financial hurricane, one whipped up by none other than Donald Trump and his escalating tariff threats. Are your investments truly safe? That's the million-dollar question, and the answer might shock you. Forget everything you think you know about market stability, because Trump's trade policies are about to rewrite the rules. I'm talking about a potential wipeout that could leave even seasoned pros scrambling. But here's the twist. Hidden within this chaos, there are opportunities to not just survive, but thrive. Stick with me, and we'll uncover them together. Let's get started. So what's the headline news? Trump's been rattling the saber again, threatening to slap a 25% tariff on European goods and even hinting at a 10% levy on everything coming out of China. This isn't just idle talk. It's a real threat that's already sending shockwaves through global markets. European stocks took a nosedive yesterday, and futures are pointing to more pain today. The euro is tanking, hitting two-week lows against the dollar. Even Canada is feeling the heat, with its currency plunging to a 3.5-week low. Trump's making it crystal clear. These tariffs are happening, and they're happening soon. The uncertainty is crippling businesses and investors alike. But why now? What's driving this renewed aggression on trade? The core issue here is economic destabilization driven by trade policy uncertainty. Trump's unpredictable approach creates massive volatility, making it impossible for businesses to plan and invest confidently. Remember the Hexaroline model? It predicts that countries will export goods that make intensive use of locally abundant factors of production and import goods that make intensive use of factors that are locally scarce. Tariffs distort this natural flow, leading to inefficiencies and higher prices for consumers. And that's just the tip of the iceberg. A paper published in the Journal of International Economics highlights the detrimental effects of tariff uncertainty on investment decisions, with firms delaying or canceling projects due to unpredictable trade costs. Think about it. If you're a CEO, are you going to invest billions in a new factory when you don't know if your products will be priced out of the market by a sudden tariff hike? This uncertainty then leads to slower economic growth, lower employment, and ultimately, a less prosperous world. We see this playing out in real time, with companies scaling back expansion plans and consumers tightening their belts in anticipation of higher prices. Furthermore, the concept of comparative advantage, central to international trade, is utterly disregarded by these blanket tariffs. Countries specialize in producing goods they can make most efficiently, benefiting everyone through trade. But when tariffs artificially inflate the cost of imports, it disrupts these efficient production chains, leading to a loss of overall economic welfare. And let's not forget the J-curve effect, which suggests that a country's trade balance will initially worsen after a devaluation or the imposition of tariffs, before it eventually improves. This initial dip can be painful, leading to short-term economic hardship and further market instability. But is there anyone benefiting from this chaos? China's reaction is far more nuanced than a simple market crash. While the threat of additional tariffs has certainly caused concern, the timing is crucial. The National People's Congress is meeting next week, and analysts are predicting a wave of new stimulus measures. This isn't just a coincidence. It's a calculated response designed to cushion the blow from Trump's tariffs and maintain economic stability. The People's Bank of China, PBOC, has even stepped in to support the yuan, setting a firmer official rate for the first time this week. This shows their determination to prevent a currency collapse and maintain control over the situation. But here's the kicker. China might actually benefit in the long run. By focusing on domestic consumption and technological innovation, they can reduce their reliance on exports to the US and build a more self-sufficient economy. This is a high-stakes gamble, but it could pay off big time in the years to come. However, other currencies, like the Australian and New Zealand dollars, are taking a beating, acting as proxies for the yuan. And the Tokyo stock market is feeling the pressure from a strengthening yen as investors flock to the traditional safe haven. Speaking of safe havens, let's talk about where smart investors are parking their money. The yen is surging, as is typical during times of global uncertainty. But the real story is in the U.S. Treasury market. Yields are sinking to new two-week lows, as traders brace for the potential damage of a global trade war. This is a clear sign that investors are worried about the U.S. economy, despite the recent signs of vulnerability. Gold is also looking attractive, poised to push to new record highs. These traditional safe havens offer a refuge from the storm, but they're not the only options. Some investors are also looking at alternative assets like real estate and infrastructure, which tend to be less correlated with the stock market. The key is to diversify your portfolio and avoid putting all your eggs in one basket. But remember, even safe havens come with risks. The yen can be volatile, treasury yields can rise unexpectedly, and gold prices can fluctuate wildly. So, do your research and understand the risks before making any investment decisions. While Trump's tariffs are grabbing the headlines, central banks are playing their own high-stakes game of chess. Traders are betting heavily on a dovish Fed, with 2 quarter-point rate cuts priced in for June and September. But will the Fed actually follow through? That depends on the economic data, particularly the PCE deflator, the Fed's preferred inflation gauge. If inflation remains stubbornly high, the Fed might be forced to hold rates steady or even raise them further. Meanwhile, the ECB is widely expected to cut rates next week. But the big question is what happens after that. Some policymakers are hinting that the pace of easing will slow, which could disappoint investors and trigger a market correction. This is a delicate balancing act, and central banks risk making a policy mistake that could derail the global economy. So, keep a close eye on the economic data and listen carefully to what central bankers are saying. Their decisions will have a major impact on your investments. The tech sector is facing its own set of challenges, with Asian markets reeling from a delayed sell-off over Nvidia's earnings. Despite the initial hype, investors are starting to worry that valuations have become unsustainable, especially with the emergence of China's lower-cost AI competitor, DeepSeek. This is a classic example of market overvaluation, where investors get caught up in the hype and ignore the underlying fundamentals. Remember the dot-com bubble? We could be seeing a similar scenario play out in the AI sector. But it's not just Nvidia. The entire tech sector is vulnerable to a correction. High-growth stocks often trade at sky-high valuations, which can be difficult to justify when interest rates are rising and economic growth is slowing. So, be careful about chasing the latest tech trends and focus on companies with solid earnings and sustainable business models. And don't forget about the Magnificent Seven, the group of mega-cap tech stocks that have driven much of the market's gains in recent years. If these stocks start to falter, the entire market could be in trouble. And if you thought the stock market was volatile, take a look at the crypto market. Bitcoin has plunged below $80,000, down as much as 27% from its record high in January. This is a stark reminder that crypto is a highly speculative asset class, prone to wild swings in price. While some investors see this as a buying opportunity, others are running for the exits. The truth is, no one knows where Bitcoin is headed next. It could rebound and reach new highs, or it could crash and burn. The key is to understand the risks and invest only what you can afford to lose. And don't be fooled by the hype surrounding meme coins like Dollar Trump and Dollar Melania. These are purely speculative assets with no intrinsic value. They're more like gambling than investing. So, stay away from the meme coins and focus on established cryptocurrencies with strong fundamentals. But even then, be prepared for a bumpy ride. So what's the bottom line? Trump's tariff threats are creating a climate of uncertainty and volatility in global markets. But within this chaos, there are opportunities to profit. Diversify your portfolio, invest in safe haven assets, and be cautious about high-growth tech stocks and meme coins. Keep a close eye on the economic data and listen carefully to what central bankers are saying. And most importantly, do your research and understand the risks before making any investment decisions. The next few weeks are going to be critical. We'll be watching closely for any new developments and providing you with actionable insights to help you navigate this turbulent market. What are your thoughts on Trump's tariffs? Are you worried about a market crash, or do you see this as a buying opportunity? Let us know in the comments below. And don't forget to subscribe to our channel for more in-depth analysis and investment strategies. Stay safe, stay informed, and stay ahead of the curve.